This conversation is powered by Google Illuminate. Check out illuminate.google.com for more. Today's discussion delves into the intricate world of Federal Reserve regulations, specifically focusing on Section 23B, restrictions on transactions with affiliates. It's a complex area, but crucial for maintaining financial stability.
Absolutely. Section 23B is designed to prevent conflicts of interest and ensure fair practices within the banking system. It's a cornerstone of regulatory oversight.
Many listeners might not be familiar with the nuances of affiliate transactions. Can you give us a simple overview of what constitutes an affiliate relationship in this context?
Essentially, an affiliate is a company closely related to a member bank, often through shared ownership or control. This could include subsidiaries, holding companies, or other entities where there's a significant financial connection. The regulation aims to prevent these relationships from being exploited for unfair advantage.
So the core principle is preventing self-dealing or preferential treatment?
Precisely. The regulation aims to create a level playing field, ensuring that transactions with affiliates are conducted on terms comparable to those offered to non-affiliated entities.
Let's look at the general restrictions outlined in subsection A. What are the key stipulations regarding transactions between a member bank and its affiliates?
Subsection A mandates that transactions must be conducted on substantially the same, or at least as favorable, terms as those offered to non-affiliated companies. This applies to various transactions, including asset sales, payments, services, and situations where an affiliate acts as an agent or broker. The key is ensuring fairness and preventing any undue benefit to the affiliate.
And what happens if there aren't comparable transactions with non-affiliates to use as a benchmark?
In the absence of comparable transactions, the terms must be those that would be offered in good faith to non-affiliated companies. This requires a demonstrable commitment to fair and market-based pricing. It's a crucial aspect of the regulation's intent.
Subsection B details specific prohibited transactions. Can you elaborate on those?
Subsection B prohibits a member bank from purchasing securities or assets from an affiliate as a fiduciary unless explicitly permitted by the governing instrument, court order, or applicable law. It also prohibits the purchase of securities during an underwriting syndicate if an affiliate is a principal underwriter, unless approved by a majority of the bank's directors as a sound investment independent of the affiliate relationship. This is a strong safeguard against potential conflicts.
The exception for director approval seems significant. What are the conditions for such an approval?
The approval must occur before the securities are offered publicly, and the directors must explicitly determine that the purchase is a sound investment regardless of the affiliate's role as a principal underwriter. This ensures a thorough and independent assessment of the investment's merits.
Subsection C addresses advertising restrictions. What's the purpose of this provision?
Subsection C prevents member banks from advertising or implying responsibility for their affiliates' obligations. This is to avoid misleading the public and to maintain clear lines of liability. It's a crucial aspect of transparency and consumer protection.
And subsection D provides important definitions. What are some key terms defined here?
Subsection D clarifies the meaning of affiliate, bank, subsidiary, person, and covered transaction, ensuring consistent interpretation and application of the regulation. It draws heavily on the definitions provided in Section 23A, but with some important distinctions to tailor the application specifically to Section 23B.
Finally, subsection E grants the board authority to issue regulations. What powers does this grant provide?
Subsection E empowers the board to create regulations to implement and enforce Section 23B. This includes defining terms, granting exemptions in the public interest with notification to the FDIC, and excluding certain subsidiaries from the definition of affiliate. This flexibility allows the board to adapt to evolving market conditions and address specific situations.
The FDIC's role in the exemption process is noteworthy. Can you explain that?
The FDIC's involvement is a crucial check and balance. The board can only grant exemptions if the FDIC doesn't object within 60 days, ensuring that any exemption doesn't pose an unacceptable risk to the Deposit Insurance Fund. This collaborative approach safeguards the broader financial system.
What are some of the practical implications of Section 23B for member banks?
Compliance with Section 23B requires member banks to establish robust internal controls and procedures to ensure that all transactions with affiliates are conducted fairly and transparently. This includes meticulous documentation, independent valuations, and regular reviews to prevent any potential violations. Non-compliance can lead to significant penalties.
How is compliance with Section 23B monitored and enforced?
Enforcement involves a combination of self-reporting by banks, regular examinations by the Federal Reserve, and potential investigations in response to suspected violations. Penalties for non-compliance can range from civil monetary penalties to more severe actions, depending on the severity and nature of the violation.
How does Section 23B relate to other Federal Reserve regulations concerning bank affiliations?
Section 23B is part of a broader framework of regulations designed to manage the risks associated with bank affiliations. It works in conjunction with other provisions, such as Section 23A, which addresses the general relationship between banks and their affiliates. The regulations are interconnected and work together to ensure a stable and sound banking system.
Are there any specific examples of situations where Section 23B has been particularly relevant or impactful?
While specific cases aren't publicly released due to confidentiality, the regulation has undoubtedly played a role in preventing potential conflicts of interest and ensuring fair practices in numerous instances. Its existence serves as a deterrent and promotes responsible behavior within the banking industry.
Given the evolving nature of the financial landscape, are there any anticipated changes or updates to Section 23B in the future?
The financial industry is constantly evolving, and regulators must adapt to new challenges and risks. Future updates to Section 23B might address emerging technologies, new types of financial products, or changes in the structure of bank affiliations. The goal remains to maintain the integrity and stability of the financial system.
What advice would you give to member banks to ensure effective compliance with Section 23B?
Proactive compliance is key. Banks should develop comprehensive internal policies and procedures, provide thorough training to employees, and conduct regular reviews to identify and address potential risks. Maintaining open communication with regulators is also crucial.
What is the overall significance of Section 23B in maintaining a healthy and stable financial system?
Section 23B is a critical component of the regulatory framework designed to prevent conflicts of interest and promote fair and transparent practices within the banking system. By preventing self-dealing and ensuring that transactions with affiliates are conducted on arm's-length terms, the regulation contributes to the overall stability and soundness of the financial system.
How does Section 23B contribute to consumer protection?
By ensuring fair and transparent transactions, Section 23B indirectly protects consumers. It prevents situations where affiliates might receive preferential treatment, potentially leading to higher costs or less favorable terms for consumers. The regulation's focus on fairness benefits the entire financial ecosystem.
What are some of the challenges in enforcing and interpreting Section 23B?
One challenge is defining comparable transactions in situations where there's a lack of readily available market data. Another challenge is ensuring consistent application of the regulation across different banks and types of transactions. Clear guidelines and effective communication are crucial to address these challenges.
How can the Federal Reserve improve its approach to enforcement and interpretation of Section 23B?
The Federal Reserve can enhance its approach through increased transparency, clearer guidance, and improved communication with member banks. Regular updates to the regulation based on market developments and lessons learned are also essential. Collaboration with other regulatory bodies can further enhance effectiveness.
How might technological advancements and financial innovation impact the application and interpretation of Section 23B in the future?
Technological advancements and financial innovation can create new challenges and opportunities for regulatory oversight. The Federal Reserve needs to adapt its approach to address the complexities of new technologies and financial products while maintaining the core principles of fairness and transparency. This requires ongoing monitoring and adaptation of the regulatory framework.
What specific technological advancements or financial innovations pose the greatest challenges to the enforcement of Section 23B?
The rise of fintech companies and the increasing use of complex financial instruments can make it more difficult to identify and monitor affiliate transactions. The use of artificial intelligence and big data analytics could help regulators enhance their oversight capabilities.
Are there any international parallels or comparisons to Section 23B and other countries' banking regulations?
Many countries have regulations aimed at preventing conflicts of interest and ensuring fair practices in banking. While the specific approaches may differ, the underlying principles are often similar. International cooperation and information sharing can help improve regulatory effectiveness globally.
How can international cooperation enhance the effectiveness of Section 23B?
International cooperation can help regulators learn from each other's experiences, share best practices, and develop more effective approaches to address emerging challenges. This can lead to a more consistent and effective global regulatory framework.
That was a great discussion. Thank you for shedding light on the complexities and importance of Section 23B. Your expertise has provided valuable insights for our listeners.